The Rebel Capitalist Show.
As far as commodities, when you guys try to figure out if they're expensive or cheap, how does that work?
Well, I guess you've got the commodity and then you've got the commodity companies, and they should never be, confused. And so just on the commodity side of things, you just say, okay, well, what's the cost of production? Can they produce this thing at a loss? Can they? And then you take above ground inventories and you say, okay, it's a little bit like FX reserves. I used to do, when I was cutting my teeth, I used to do Forex trading. So, you'll look at countries and say, okay, especially dollar peg countries. I had a mate who was at Deutsche years back, and he used to, he ran like an arbitrage set up on currencies, and then he had basically his tail end stuff, which he had about 2% in, was always like pegs and things that were semi pegged, and that was just his asymmetric kind of like playoff. But in that respect, he was always just looking and saying, okay, well, what is the underlying commodity? Because it's often commodity countries, that are pegging their currency. Not always, but quite often. And then it's okay, well, what's the cost of production of that? Say it's oil. Like take right now, Oman's a good example. Oman's pretty fucked. I mean, they can't pay their bills. So, and they're a dollar peg, right? So you take a country like that and say, okay, fine. What's the cost of production? What is their overall cost? You take in social spending, all that kind of stuff, and say, okay, the cost of production for them is $20. And if the price of oil is $9, it's okay. What's the FX reserves look like? In other words, how long can they hold the peg? And you just build all these macro models on it. And so I tend to like use a similar kind of modeling with respect to commodities. And you say, okay, what is the cost of production? How much is that we know of above ground inventory? What does demand look like? What is the actual commodity? And then if you can get comfortable with that commodity and you go, well, that's great, then fine. Then you say, well, if you want leverage behind it, then you can buy the equities. And then, similar approach, we were looking and saying, okay, who's going to survive? That's the main thing. It's like you if you're going to ride that massive trend, you don't want to be right about a sector and then cock it up because you bought the wrong company. So we'll buy a bunch of different companies, but we're always trying to find those that will first and foremost survive. And you might go and take, a 0.5% position or something in something that's more levered and it's got, potential. But for the most part, that's not how we go about it.
For the viewers who don't know, I think Chris and his team have a very similar mindset to me, where they think that commodities are very cheap right now. I was talking to someone the other day that pointed out a chart that shows how the stock market compared to commodities, the gap between them is at an all-time high. So stocks are at an all-time, I don't know how you should say it, or stocks are expensive compared to commodities or vice versa. And that gap has never been as extreme as it is today. So Lynn, how do you look at commodities?
So for the monetary commodities, right? So if you take gold and then to some extent silver and Bitcoin, I do a lot of ratio comparisons to the money supply, because the whole thesis of a monetary metal, like gold is the primary example, is that it retains its value over the long term. It has these volatile periods, but essentially it maintains purchasing power, from decade to decade. And whereas, let's call it dollars. Let's focus on the U.S., but it would apply to any country. As the number of dollars, especially dollars per capita, keeps expanding dramatically, but gold remains relatively fixed per capita. Because the production rate is roughly the same as population growth. So I do a lot of ratio work to compare, okay, what is gold worth compared to how it was, in the 90s, or how it was in the 1970s, or even further back, compared to how many dollars have been created since then, especially on a per capita basis. So I do that ratio work. And then I also look at things like gold to Dow ratio or gold to S&P 500 ratio to see how, how does the money supply compare to gold? How does the stock market compare to gold? How does the overall credit market compare to gold? Because as we get further into a long-term debt cycle, I'm sure you've heard of Exner's pyramid, right? Which is like the inverse pyramid that shows if you start from the bottom, you have like gold, and then you have cash, and as you go up, you get into these larger and larger sections of the financial system, right? So you get into credit, you get into equities, and towards the end of a long-term debt cycle like we're at now, the pyramid is very wide, but it's inverted, which means when it's wide, it's more unstable, right? So when that long-term debt cycle unwinds and they do a large currency devaluation, it generally narrows the pyramid, which means a lot of money printed compared to the amount of gold in the system, and even compared to the amount of credit in the system.
When you're comparing money supply to gold, are you using broad money or base money?
I do a couple of different methods, but primarily I use broad money. I find that the more accurate depictor.
Okay. And just for definition, guys, that would be the M2 money supply.